Welcome back to Financial Market Insights for Traders. I'm Sophia, and today we are diving into one of the most debated and important topics in today's economic climate: gold versus Bitcoin inflation. Which hedge actually works better when inflation rises? Inflation isn't theoretical anymore. It's not just something economists argue about on television. It's something people feel. Grocery bills creep higher. Energy prices fluctuate sharply. Rent increases faster than expected. Over time, inflation quietly erodes purchasing power. The same amount of money buys less. And when that reality sets in, investors start asking serious questions about how to protect their wealth. That's where the gold versus Bitcoin debate comes in. On one side, we have gold, a store of value that has survived wars, currency collapses, financial crises, and entire empires rising and falling. On the other side, we have Bitcoin, a digital asset created after the 2008 financial crisis, built specifically to resist central bank money printing and currency debasement. So the real question is not just which asset performs better, it's which asset actually functions as a reliable hedge against inflation. To answer that, we first need to think about what makes a good inflation hedge in the first place. A true hedge should maintain or increase purchasing power when fiat currencies lose value. It should have limited supply. It should be liquid and accessible. And perhaps most importantly, it should inspire long-term confidence, especially during economic stress. Let's start with gold. Gold has been trusted for thousands of years. Across continents and cultures, gold has consistently represented wealth and stability. That historical track record matters more than people sometimes realize. Gold has already been tested under conditions of hyperinflation, sovereign debt crises, geopolitical instability, and currency devaluation. Take the 1970s in the United States as an example. Inflation surged into double digits. The dollar weakened significantly. During that decade, gold prices rose dramatically. Investors who held gold during that inflationary period preserved and, in many cases, grew their purchasing power. One of the core reasons gold performs during inflation is scarcity. Gold cannot be printed. It cannot be created by policy decisions. Mining requires time, capital, and labor. Supply growth is slow and constrained by physical reality. There's also something psychological about gold. It's tangible. You can hold it. It doesn't rely on electricity, servers, or digital networks. When financial systems feel unstable, that physical nature provides reassurance. But gold isn't flawless. It doesn't generate income. There are no dividends, no yield. If you hold physical gold, there are storage and insurance costs. And during strong economic expansions, when equities are booming and risk appetite is high, gold can lag behind. Gold is defensive. It's designed to preserve wealth, not necessarily multiply it rapidly. Now let's shift to Bitcoin. Bitcoin was launched in 2009, directly after the global financial crisis. It was created in an environment of deep mistrust towards centralized banking systems. Its design is fundamentally different from gold's, but it shares one critical trait: scarcity. Bitcoin supply is capped at 21 million coins. That limit is written into its code. No government can decide to issue more. No central bank can expand its supply to stimulate the economy. That fixed supply is the foundation of Bitcoin's argument as an inflation hedge. When governments print money aggressively, Bitcoin supporters argue that digital scarcity becomes more valuable. Over the past decade, Bitcoin has delivered extraordinary returns. It has gone from being nearly worthless to reaching valuations that rival major corporations and even national currencies in scale. But here's where the conversation becomes more complex. Bitcoin is extremely volatile. It has experienced multiple price declines of 50% or more. It can move 10% in a single day. That kind of volatility creates opportunity for traders, but it also introduces significant risk for investors seeking stability during inflationary periods. If inflation is rising and your hedge drops 40% in a few months, it doesn't feel like protection, even if it eventually recovers. Another critical difference in the gold versus Bitcoin inflation debate is correlation with traditional markets. Gold often has low or even negative correlation with equities during times of crisis. When stock markets decline due to economic fear, gold frequently benefits from safe haven demand. Bitcoin's behavior has been less consistent. In recent years, it has often moved in tandem with technology stocks and other risk assets. When central banks raise interest rates to fight inflation, Bitcoin has sometimes declined alongside equities. That raises an important question. Is Bitcoin currently behaving like a hedge against inflation, or is it acting more like a high growth, liquidity sensitive asset? The answer may evolve over time, but so far, Bitcoin's role remains somewhat transitional. Then there's institutional adoption. Gold is universally accepted by central banks. It sits in national reserves. It operates within established regulatory frameworks. Its legitimacy in the global financial system is unquestioned. Bitcoin, while increasingly adopted by institutions and corporations, still faces regulatory uncertainty in many regions. Some governments embrace it, others restrict it. That regulatory variability adds another layer of risk. Now let's talk about scarcity more deeply. Gold scarcity is geological. It requires physical extraction. Supply increases slowly and predictably. Bitcoin scarcity is mathematical. Its issuance schedule is transparent and predetermined. Some argue that Bitcoin's digital scarcity is even more reliable than gold's because it is absolute and verifiable. However, Bitcoin depends on digital infrastructure. It requires networks, electricity, and cybersecurity. Gold does not share those dependencies. When we look at performance during economic stress, gold has repeatedly proven itself across multiple generations. It has weathered currency collapses, wars, banking crises, and inflationary spirals. Bitcoin has not yet faced a prolonged, multi-decade global inflation cycle. Its long-term resilience under those conditions remains to be fully tested. So where does that leave us? For many investors, the answer is not either/or. It's both. A diversified hedge strategy might include gold as a foundation for stability and Bitcoin as a growth-oriented complement. The exact allocation depends on your risk tolerance, time horizon, and macroeconomic outlook. If you are conservative and value stability, gold may deserve a larger allocation. If you are comfortable with volatility and believe in the long-term adoption of decentralized digital assets, Bitcoin may justify a meaningful position. But whichever direction you lean, execution matters. Access to a reliable, user-friendly trading platform can shape your experience. If you're looking for a world-class, cutting-edge trading platform app designed for modern markets, you can explore Crystal Ball Markets at crystalballmarkets.com/platform. It's built to provide efficient access to a wide range of assets, including metals and digital currencies. And education is just as important as execution. Inflation hedging requires understanding macroeconomic cycles, interest rates, liquidity conditions, and risk management. If you want beginner-friendly discussions on trading, investing, macro trends, and financial markets, you can tune into the Crystal Ball Markets podcast at iss.com/podcast/crystalballmarkets. It's a valuable resource for building clarity and confidence step by step. So when it comes to gold versus Bitcoin inflation, there is no simple winner. Gold offers centuries of trust, lower volatility, and institutional validation. Bitcoin offers digital scarcity, innovation, and high growth potential, but with greater risk. Inflation challenges every investor. It quietly reduces purchasing power over time. Protecting wealth requires strategy, discipline, and understanding. The smartest approach may not be choosing sides. It may be understanding how each asset fits within your broader financial plan. And that's exactly what we aim to explore here on Financial Market Insights for Traders. I'm Sophia. Thank you for listening, and I'll see you in the next episode.